Ladies and gentlemen, buckle up because we stand on the brink of one of the most consequential financial shifts of our lifetimes. What you think you know about money, markets, and wealth protection is about to be turned upside down. And if you currently own silver, what I'm about to share with you isn't just important, it could be catastrophically relevant for your financial future. For years, I've warned that excessive debt, reckless monetary policy, and currency manipulation would eventually force people to re-evaluate what real money is. What mainstream economists call normal markets are anything but. They are distortions created by central banks that act as if printing money is a growth strategy. But you don't have to accept the narrative. You only have to open your eyes and see what the market is already telling us. Most people don't realize it yet, but the calm you see on the surface of the global economy is nothing more than an illusion. It's the kind of calm you get right before a storm hits with full force. The warning signs are everywhere, but they're being ignored, downplayed, or deliberately misrepresented. Governments tell you everything is under control. Central banks insist inflation is temporary, debt doesn't matter, and money can be created without consequence. History tells a very different story, and history is about to repeat itself in a way that will catch millions completely unprepared. For years, the global economy has been running on borrowed time and borrowed money. Growth hasn't been real. It's been manufactured through artificially low interest rates and relentless money printing. Instead of allowing bad investments to fail and markets to correct naturally, policymakers chose to delay the pain. They flooded the system with cheap credit, rewarded debt, and punished savers. That decision didn't solve the problem. It magnified it. Every cycle of intervention made the next crisis larger, deeper, and more dangerous. What we're facing now isn't just another recession. It's the inevitable consequence of decades of financial mismanagement. Government debt has exploded to levels that can never realistically be repaid. The only way out, politically speaking, is inflation. Not the kind of inflation that officials admit to on television, but the kind that quietly destroys purchasing power, erodes savings, and transfers wealth from the public to the state. Inflation is the default setting of a debt-based monetary system that's reached its breaking point. People are told that strong job numbers and rising asset prices mean the economy is healthy, but those numbers are distorted by the very policies that caused the problem. When money is cheap and abundant, asset prices inflate, stocks rise, not because businesses are fundamentally stronger, but because currency is weaker. Real wages fall even as nominal wages rise. Consumers feel poorer even when they're told they're doing better. That disconnect is one of the clearest signs that something is deeply wrong. The most dangerous part of this storm is that confidence is the only thing holding the system together. Fiat currencies have no intrinsic value. They rely entirely on trust that governments will act responsibly, trust that central banks can control outcomes, trust that inflation will remain contained. Once that trust cracks, events move very fast. Currency crises don't unfold gradually. They happen suddenly and then all at once. By the time the average person realizes what's happening, the damage is already done. What makes this moment especially urgent is that policymakers have boxed themselves into a corner. Interest rates can't rise significantly without triggering a debt crisis. Cutting rates, again, would fuel even more inflation. Printing more money only accelerates the loss of purchasing power. Every available option leads to the same destination, a weaker currency and higher prices. The storm isn't coming because of a single mistake. It's coming because there is no longer a viable escape route. Throughout history, whenever governments have abused their currencies, people have eventually turned back to real assets, not promises, not paper claims, real tangible stores of value that can't be created out of thin air. This shift always begins quietly. While most people are still distracted by headlines and short-term market moves, then it becomes obvious. And once it's obvious, it's too late to prepare cheaply or easily. The warning signs right now are flashing red: persistent inflation, rising geopolitical tensions, supply chain vulnerabilities, growing distrust in institutions. These are not isolated issues. They are interconnected symptoms of a system under extreme stress. The longer the storm is delayed, the more violent its eventual arrival will be. And make no mistake, delaying the storm doesn't prevent it. It only ensures that when it arrives, it does more damage. The tragedy is that many people still believe they'll get a clear signal when it's time to act. They won't. Crises don't send invitations. They don't wait for consensus. The window to prepare is always before the panic begins, not after. Those who wait for absolute certainty end up paying the highest price. Those who understand history, incentives, and basic economics act early, not because they're fearful, but because they're realistic. This is not about predicting the exact date or trigger. It's about recognizing the direction. The storm ahead is the result of years of policy choices that favored short-term comfort over long-term stability. That bill is coming due. The only real question is whether you acknowledge the warning now, while you still have time to position yourself wisely, or whether you trust the same voices that told you there was nothing to worry about in the first place. When this storm finally breaks, people will say it came out of nowhere. It won't have. The signs have been clear all along. The economy has been living on borrowed time, and the clock is almost out. Silver is one of the most misunderstood assets in the financial world, and that misunderstanding is exactly why the opportunity still exists. Most investors don't take it seriously. They see it as a cheaper version of gold, a volatile commodity that moves too much and does nothing. That attitude is not only wrong, it's dangerous because it blinds people to what silver actually represents and why it is uniquely positioned for a historic move. For centuries, silver wasn't viewed as a speculative asset. It was money, real money. Long before fiat currencies, long before central banks, silver played a critical role in global trade and savings. The only reason it no longer circulates as money today isn't because it failed, but because governments replaced it with paper they could print without limit. That decision didn't make silver obsolete. It made currencies weaker. And now, after decades of abuse, those weaknesses are becoming impossible to ignore. What makes silver especially compelling right now is that it sits at the intersection of two powerful forces. On one side, it is a monetary metal, a store of value that protects against currency debasement. On the other side, it is an essential industrial metal with real growing demand. Very few assets have that dual nature. Gold is primarily monetary. Industrial commodities are mostly cyclical. Silver is both, and that combination is explosive in an environment where currencies are losing purchasing power while industrial demand continues to expand. Despite this, silver remains historically cheap relative to gold. The ratio between the two metals tells a story that most investors overlook. When confidence in paper money erodes, silver has a long track record of outperforming gold on a percentage basis. It doesn't move first, and it doesn't move quietly. It lags, consolidates, and then suddenly catches up violently. By the time the move is obvious to the public, prices have already adjusted dramatically. Another reason silver is poorly understood is because paper markets have distorted its price. The majority of trading volume doesn't involve physical metal at all, but contracts, derivatives, and promises. This creates the illusion of supply that doesn't actually exist in the real world. Physical silver is finite. It must be mined, refined, and delivered. When demand shifts from paper claims to actual metal, the disconnect between price and reality becomes impossible to maintain. Unlike gold, much of the silver that has been mined throughout history has been consumed. It's sitting in landfills, embedded in electronics, or lost to industrial use. That means above ground stockpiles are far smaller than most people realize. At the same time, new supply isn't easy to bring online. Mining is expensive, time-consuming, and increasingly restricted by regulation and energy costs. Supply is constrained at the exact moment demand is positioned to surge. Then there's psychology. Silver doesn't attract attention until it's already moving. Investors chase performance, not value. When silver is quiet, it's ignored. When it starts rising, it's dismissed as temporary. And when it finally explodes, everyone suddenly wants in at the same time. That behavioral pattern has repeated over and over again, and there is no reason to believe this cycle will be different, especially given the macroeconomic backdrop we're facing now. The real catalyst isn't hype or speculation. It's monetary reality. Governments cannot solve debt problems honestly. They solve them by devaluing currency. Every time a central bank expands its balance sheet, every time deficits are monetized, the real value of money declines. Precious metals don't rise because they change. They rise because money does. Silver, being smaller and thinner than gold, reacts more aggressively once the shift begins. What makes this moment particularly significant is that silver hasn't yet reflected the full extent of monetary debasement already in the system. Inflation has been embedded for years, but silver prices still lag behind where they would be in a truly free and honest market. That gap represents potential energy. When the release comes, it won't be gradual. Markets don't move in straight lines, but they do move decisively once perceptions change. People assume they'll have time to react. They won't. Silver markets are not deep enough to absorb sudden mass interest without sharp price adjustments. When the rush begins, whether driven by inflation fears, currency weakness, or loss of confidence, supply will not magically appear to meet demand. Prices will do the balancing, and they will do it quickly. Silver's greatest strength is also its greatest weakness in the eyes of the uninformed. Volatility. But volatility isn't risk when you understand the direction. It's opportunity. Silver doesn't whisper. It shouts. And when it finally does, it tends to shock those who underestimated it. The biggest mistake investors make with silver is assuming that because it hasn't moved yet, it won't. That's exactly how major moves are born, in boredom, disbelief, and neglect. Silver doesn't need universal agreement to rise. It only needs reality to assert itself, and reality is catching up fast. Most people believe preparation is something you do once a crisis is obvious. That belief is exactly why so many people get wiped out when reality finally hits. By the time everyone agrees there's a problem, preparation is no longer possible, at least not without paying an enormous price. The truth is, preparation only matters before the warning becomes consensus. And right now, the window to prepare is closing faster than most people realize. The biggest mistake investors make is assuming they'll have time. They think markets will give polite signals, gradual declines, and clear instructions. That's not how financial crises work. They move slowly for years, and then suddenly all at once, what looks stable one moment becomes disorderly the next. Liquidity disappears, prices gap, rules change overnight, and the people who plan to act later discover that later never arrived. For years, the system has been held together by confidence and intervention. Every time something threatens to break, central banks step in with more money, more debt, and more promises. That approach doesn't eliminate risk, it concentrates it. It builds pressure beneath the surface. And the longer that pressure builds, the more violent the release becomes when it finally breaks through. Preparing now isn't about panic, it's about acknowledging reality. The math no longer works. Governments are spending far more than they can collect. Debt is compounding faster than growth. Interest rates can't rise meaningfully without triggering systemic failure. That leaves only one path forward: currency debasement. You don't need a crystal ball to see where that leads. History has already shown the ending countless times. People are conditioned to believe that doing nothing is the safe choice. Staying invested in familiar assets feels comfortable. Holding currency feels stable. Trusting institutions feels normal. But comfort is not safety. In fact, comfort is usually the biggest risk because it discourages action when action is still possible. By the time discomfort forces change, the damage is already done. Preparation requires acting when it feels unnecessary. It means positioning yourself before headlines demand it, before markets price it in, and before the crowd rushes in the same direction. That's uncomfortable. It feels lonely, and it often invites criticism right up until the moment it proves essential. Another reason preparing now is critical is that access changes during crisis. Assets that are easy to buy today become scarce tomorrow. Liquidity dries up, premiums rise, restrictions appear. Governments impose controls not to protect you, but to protect the system. Once that happens, your choices shrink dramatically. The idea that you'll simply adjust later assumes conditions that won't exist later. People underestimate how quickly trust can evaporate. Financial systems are built on belief in currencies, belief in banks, belief in policymakers. Once that belief weakens, behavior changes instantly. People move from complacency to fear in a heartbeat. And fear is not rational. It doesn't wait for confirmation. It reacts, and it reacts aggressively. Preparing now also means understanding that diversification within the same fragile system is not true protection. Owning different paper assets that all depend on the same monetary foundation doesn't reduce risk. It disguises it. When the foundation cracks, everything built on it shifts at the same time. Real preparation means stepping outside the assumptions that the system requires you to believe. The irony is that preparation feels most difficult when it's most effective. When markets are calm, preparation seems unnecessary. When prices are stable, protection feels expensive. When confidence is high, caution feels foolish. That psychological trap is what catches people cycle after cycle. They confuse the absence of panic with the absence of risk. Waiting for certainty is another trap. Absolute certainty never arrives before a crisis, only after. If you wait until everyone agrees something is wrong, you are no longer preparing. You are reacting, and reactions are almost always late, emotional, and costly. Preparation is proactive by definition. It accepts uncertainty and acts anyway. What's especially dangerous about the current environment is that people believe past rescues guarantee future ones. They assume central banks will always step in, markets will always recover, and paper losses will always reverse. That belief ignores scale. The tools that worked when debt was smaller don't work when debt is massive. The medicine that stabilized the patient has now become the disease. Preparing now is about preserving purchasing power, flexibility, and control. It's about reducing dependence on promises that can be broken and systems that can be altered overnight. It's about acknowledging that stability built on debt and money creation is temporary by nature. The people who come through storms intact are not the smartest or the luckiest. They are the ones who acted early, quietly, and deliberately before preparation became fashionable, before fear became contagious, and before options disappeared. The clock doesn't announce when it's about to run out, it just runs. And right now, it's closer to zero than most people want to admit. Silver occupies a rare position in the financial world, one that most investors fail to fully appreciate. It isn't just a hedge against monetary chaos, and it isn't just another industrial commodity tied to economic cycles. It is both at the same time, and that dual identity is exactly what makes it so powerful in the environment we are moving into. People like to put assets into neat categories, but silver refuses to fit cleanly into any single box, and that confusion is precisely why it continues to be mispriced. As a safe haven, silver shares the same fundamental characteristics that have made precious metals valuable for thousands of years. It is tangible, it is scarce, it cannot be created by government decree or central bank policy. When currencies lose purchasing power, silver doesn't become more valuable, money becomes less valuable relative to it. That distinction matters. Precious metals don't rise because they change, but because the measuring stick used to price them is shrinking. Silver simply reflects that reality, often more dramatically than people expect. But unlike gold, silver doesn't rely solely on monetary demand. It has real-world utility that extends far beyond wealth preservation. Silver is an essential input in modern industry. It is used in electronics, medical equipment, energy systems, and countless technologies people rely on every day. As economies become more technologically dependent, silver's industrial relevance increases, not decreases. This creates a base level of demand that exists regardless of investor sentiment. That industrial demand is not optional. It cannot be replaced easily. And in many applications, it cannot be replaced at all without sacrificing efficiency or performance. As global infrastructure expands and technology advances, silver consumption rises quietly in the background. Most people never see it happening, but it steadily absorbs supply year after year. This is very different from assets whose demand is purely speculative. The supply side of silver tells an equally important story. Silver is not produced on demand. Much of it is mined as a byproduct of other metals, which means supply doesn't respond quickly to price signals. Even if prices rise, new production cannot be ramped up overnight. Mining projects take years to develop, require enormous capital, and face increasing regulatory and environmental constraints. This creates a structural tightness that becomes critical when demand accelerates. What makes this setup especially compelling is that the monetary and industrial sides of silver do not compete with each other. They reinforce each other during times of economic stress. Monetary demand increases as people seek protection from currency debasement. At the same time, long-term industrial demand continues, driven by technological and infrastructure needs. That combination puts pressure on a market that is far smaller and less liquid than most investors realize. This where silver's safe haven role becomes misunderstood. People assume safe havens should be calm and stable. Silver is neither. It is volatile not because it is risky, but because it is thinly traded relative to the forces that can impact it. When confidence in paper assets erodes, even a modest shift in capital can have an outsized effect on silver prices. That volatility is not a flaw. It is a signal of how sensitive the market is to changes in perception. The industrial side adds another layer of support that gold does not have. Even in periods where investment demand slows temporarily, industrial use continues to draw down available supply. Over time, much of that silver is consumed and not recovered. Unlike gold, which is mostly stored and reused, silver is often lost after industrial application. This means the above ground stockpile shrinks even as long-term demand grows. People often assume that because silver has an industrial component, it must suffer during economic downturns. That assumption ignores the broader context. Economic downturns caused by monetary mismanagement do not eliminate the need for technology, energy, or infrastructure. In many cases, government responses to downturns involve spending programs and monetary expansion that actually increase demand for industrial metals while simultaneously undermining currency value. Silver benefits from both sides of that equation. Another overlooked aspect is affordability. Silver remains accessible to a far wider range of people than gold. That matters when monetary fear spreads beyond institutional investors to the general public. When confidence breaks, people don't all move into large, expensive assets at once. They move into what they can afford. Silver becomes the entry point, and that broad participation amplifies demand dramatically. The safe haven narrative around silver is often dismissed because it doesn't behave like a traditional insurance policy. It doesn't move gradually. It doesn't provide comfort. It moves in bursts, often after long periods of neglect. But when it moves, it reflects a fundamental shift in how people view money, risk, and trust. Those shifts don't reverse easily. Silver's dual role means it doesn't need a single perfect scenario to perform. Inflation, currency debasement, technological expansion, energy transitions, loss of confidence, any one of these supports silver. When several occur at once, the effect compounds. That is why silver doesn't require precise timing to make sense. It requires understanding. The greatest mistake investors make is trying to analyze silver using only one lens. They either see it as money or as a commodity. In reality, it is both, and in a world where monetary systems are under strain and industrial demand continues to grow, that combination is not a weakness. It is a force that very few are prepared for. So today I ask you, are you ready? Are you going to be among the millions blindsided by another market collapse, or are you going to act before history repeats itself? Because the truth is simple. Silver isn't just a metal, it's a wake-up call. And if you're listening to me right now, you still have time, but not much. Get prepared, protect your wealth, and watch closely, because what's coming will separate those who understood the warning from those who didn't. This isn't fear, it's foresight. And the opportunity is now.